$12. That is how much silver lost in just 48 hours. From a Monday high of $97 down to a Tuesday low of $85. $12 per ounce gone. On the surface, it looks like a routine market correction, a natural pullback after an aggressive, war-driven rally. That is exactly what they want you to believe. That is the story being pushed right now on every financial news channel and every mainstream market commentary. Silver got ahead of itself. Silver was overbought. Silver needed to pull back. Except this pullback was anything but natural. It was engineered. It was planned. It was filed with CME Group at precisely 11:47 p.m. on Monday night, and it was executed through a cascade mechanism that had been designed months, possibly even years in advance, built specifically for moments like this. Tonight, I'm going to break down the entire operation piece by piece, using nothing but publicly available exchange data, filing timestamps and price records that anyone with an internet connection can go and verify themselves. The filing. CME Group Advisory Notice 26303. Filed Monday, March 3rd at 11:47 p.m. Eastern Time. Contents, effective immediately for the next trading session. Initial margin on silver futures contracts increased from $11,500 per contract to $14,950 per contract. That is a $2,450 increase per contract. That is 30%. Maintenance margin was increased proportionally. The notice is sitting on CME's website right now. You can pull it up yourself, verify the timestamp, verify the percentage, verify the effective date. This is not a rumor. This is an official exchange filing. Now let me explain exactly what a 30% margin increase does to a market at 11:47 p.m. and why the timing matters far more than the percentage itself. Margin is the cash deposit required to hold a futures position. Think of it as collateral. If you're holding 10 silver contracts at $11,500 margin, you need $115,000 sitting in your account. When CME bumps that to $14,950, your requirement jumps to $149,500. That is an additional $34,500 you need to produce immediately. Not tomorrow, not next week, immediately. Because the notice says effective for the next trading session, and the next trading session is only hours away. Most futures traders, both retail and small institutional, operate with margin utilization somewhere between 70 and 90%. They are using most of their available capital as collateral. That is completely normal. Exchanges set margin levels specifically to define how much leverage participants are allowed to use. But when you raise that margin level by 30% overnight, you are retroactively telling everyone who sized their positions based on the old rules that they are now in violation of brand new rules. Rules that did not exist when they placed their trades. Rules that appeared at 11:47 p.m. while they were asleep. Here is how the cascade mechanism works. Stage 1. The filing hits at 11:47 p.m. CME's electronic systems push the new margin requirements to all clearing firms within minutes. Clearing firms are the intermediaries sitting between individual traders and the exchange. They are responsible for making sure their clients meet margin requirements at all times. The moment clearing firms receive the new numbers, their automated risk management systems begin scanning every single client account against the new thresholds. Stage 2. Between midnight and 2 a.m., the scanning is complete. Every account holding long silver futures positions has been evaluated. Accounts with enough excess capital to absorb the 30% increase are flagged green. Accounts without enough excess capital are flagged for margin call. At 70 to 90% utilization, a 30% margin increase will flag approximately 40 to 60% of all long positions for margin call. That is not a small number. That is potentially half of all long holders suddenly in violation of requirements because the rules changed while they slept. Stage 3. Between 2 a.m. and 3 a.m., margin call notices start firing. Automated systems at brokerages send electronic notifications to every flagged account. Those notifications come with a deadline to deposit additional funds, typically 1 to 2 hours during overnight sessions. Some brokerages have immediate liquidation policies for overnight margin deficiencies. They do not wait for the deadline. They begin liquidating the moment an account falls below maintenance margin under the new requirements. Stage 4, 3 about 12 a.m. Eastern. The first wave of forced liquidations executes. Brokerage systems begin selling silver futures contracts from every account that has failed to meet the new margin requirements. These sell orders hit the market simultaneously because multiple brokerages are all processing the exact same margin change at the exact same time. The clustering of sell orders in a narrow window during the lowest liquidity period of the trading day creates maximum price impact. Silver drops from approximately $89 to $87 in 11 minutes. Stage 5, that drop from $89 to $87 triggers a second tier of margin calls. Accounts that had just enough capital to survive the initial 30% increase, but not enough to absorb the 30% increase plus a $2 price decline, are now flagged. Their positions are liquidated. More selling. Silver drops to $86, which triggers a third tier. More liquidation. Silver drops to 85.15. The cascade is entirely self-reinforcing. Each wave of forced selling creates the price decline that triggers the next wave of forced selling. The margin increase was the match. The cascade was the fire. And the thin 3 a.m. liquidity was the gasoline. Let me put a number on the damage. Open interest declined by approximately 1,800 contracts on Tuesday. Each contract represents 5,000 ounces. That is 9 million ounces of silver positions liquidated by margin calls at an average liquidation price of roughly $86 to $87 per ounce. That represents $774 million to $783 million in forced selling. But the total price impact extended far beyond just the liquidated contracts. The $12 decline from $97 to $85 applied across the remaining open interest of approximately 120,500 contracts at 5,000 ounces each equals 622 million ounces of notional exposure. $12 multiplied by 622 million equals $7.47 billion in market value destruction. $747 billion created by a filing at 11:47 p.m. Now let me show you the historical pattern. Because Tuesday was not the first time CME deployed this weapon against silver. Every single previous deployment shares the same characteristics, same timing, same mechanics, same beneficiaries. May 2011, silver approaching $50. CME raised margins 5 times in 8 days, 5 times. Every single increase was filed after hours. Every single increase triggered an overnight liquidation cascade. Silver crashed from $40 to $30, a 35% decline in 12 trading days. The concentrated commercial short position recovered billions in unrealized losses. The CFTC investigated and took no action against the exchange. September 2020, silver rallied from $12 to $29 during the post-pandemic precious metal surge. CME raised margins twice in rapid succession. Silver corrected from $29 to $22, a 24% decline. Same pattern. After-hours filing. Overnight liquidation, short position relief. January 2021. The Wall Street bets silver squeeze attempt. Silver spiked toward $30. CME raised margins aggressively. Silver was pushed back to $25, a 16% decline. Same pattern. After hours, overnight cascade. Short sellers breathe. February 2024. Silver breaking out above $26. CME raised margins. Silver pulled back to $23, 12%. Same pattern. March 2026. Silver at $97, approaching $100. CME raised margins 30%. Silver crashed to $85, another 12%. Same pattern, same playbook, same result, different numbers, but identical mechanics. 5 documented instances. Every single one occurred when silver was approaching or breaking through a price level that threatened concentrated short positions. Every single one was filed after hours. Every single one triggered overnight forced liquidation. Every single one produced a 10 to 35% decline. And every single one was followed by silver eventually recovering and exceeding the pre-margin hike price level. Every single time. Now, 2011 was somewhat different because the physical market was not in structural deficit at the time. There was no sustained industrial demand growth, no solar mandate, no AI build-out, no defense procurement surge. The 2011 squeeze was purely speculative, and the margin weapon killed the speculation. The physical fundamentals simply did not support the price. 2026 is structurally different. 6 consecutive years of supply deficit, 800 million ounces of cumulative depletion, COMEX registered inventory at 88.4 million ounces and falling, March delivery standing at 52.6 million ounces, lease rates running at 6 to 8%, solar mandates, AI infrastructure, military procurement, central bank pilots. The physical fundamentals in 2026 are the strongest in silver's recorded history. The margin weapon can temporarily suppress the paper price, but it cannot suppress physical demand. And physical demand is what ultimately determines the price. Now, let me address the question that should be obvious by now. Is it legal for CME to raise margins specifically to crash silver and benefit short sellers? The answer is technically yes, but practically very complicated. CME Group is a self-regulatory organization. They have the authority to set margin levels at their own discretion. Their stated rationale for margin increases is risk management. When volatility rises, they raise margins to protect the financial integrity of the clearing system. That rationale sounds perfectly reasonable on the surface, but examine how it is actually applied. Silver's realized volatility had actually been declining in the sessions leading up to the margin increase. Monday was an up day, but the percentage move was only 2.3%, not extreme by silver standards. Friday was 6.3%, which is elevated but not unprecedented. The actual volatility metrics did not justify a 30% emergency margin increase. Compare that to oil, which has been significantly more volatile during the same period, with 13% single session moves. CME did not raise oil margins by 30%. Gold has had $100 single session moves. CME did not raise gold margins by 30%. Only silver received the 30% overnight treatment. Why only silver? Because silver is the only metal where a concentrated short position of 40,000 contracts exists at a major commercial bank. Oil shorts are distributed across dozens of participants. Gold shorts are spread more broadly. Silver shorts are concentrated in 4 or fewer banks, with one bank historically holding the majority. The margin increase specifically targeted the one metal where the concentrated shorts needed relief, and specifically did not target the metals where concentrated shorts do not exist. The CFTC, the Commodity Futures Trading Commission, is supposed to oversee all of this. They are supposed to ensure that exchange actions do not unfairly benefit specific market participants. Former Commissioner Bart Chilton publicly criticized the CFTC's failure to address silver market concentration and manipulation before his death. He stated on record that the Commission was aware of the concentration problem and chose not to act. Ted Butler has filed hundreds of complaints and public comments with the CFTC over 20 years, documenting this exact pattern of margin increases targeting silver, specifically during rallies that threaten concentrated shorts. The CFTC has never taken enforcement action against CME for the timing of these margin increases. JP Morgan paid $920 million in 2020 for manipulating precious metals markets between 2008 and 2016, thousands of documented instances of spoofing, criminal charges against individual traders. The settlement explicitly covered the silver market. The margin increase pattern I am describing tonight operated during the same period covered by that settlement. The same bank that was fined for manipulating silver prices was simultaneously benefiting from margin increases that crashed silver prices during those same years. Both of these facts exist simultaneously in the public record. Now, what happens next? Because the historical pattern tells you exactly what to expect. After every previous margin hike crash, silver consolidated for 1 to 4 weeks at the new lower price level. During consolidation, physical demand increased because lower prices attracted buyers. ETF inflows accelerated. Industrial consumers locked in forward purchases. The physical market tightened further, even while the paper price was being suppressed. Then the fundamental pressure overwhelmed the margin-induced selling. New buyers replaced the liquidated longs. The paper price recovered to the pre-hike level, then exceeded it. And the short sellers found themselves in an even worse position than before because the floor had been confirmed and tested, and the next advance had a stronger foundation underneath it. This is already happening. Tuesday's low of $85.15 bounced immediately. Institutional buying between $85 and $86 was aggressive and deliberate. Physical premiums held at $3.50 to $5 over spot, meaning real silver never actually traded at $85. It traded at $88 to $90 in the physical market, while the paper fiction printed $85. SLV saw continued creations, hundreds of millions in fresh buying. American and British investors treated the margin crash as a sale, not a warning. COMEX registered inventory unchanged at 88.4 million ounces. Not 1 ounce was added to the vault by the margin increase. Delivery standing unchanged at 52.6 million ounces. Not one buyer canceled because the paper price dropped $12. Lease rates unchanged at 6 to 8%. Not 1 basis point of relief for the short sellers' daily borrowing costs. The $4.2 million per day bleed continues, regardless of what the paper price does. Here's the strategic view. CME has now used the 30% margin increase tool. It is spent. They can raise margins again, but the market now expects it. Traders who survive Tuesday's margin call will have deposited excess capital to withstand the next increase. The effectiveness of margin hikes diminishes with every deployment because the surviving trader population adapts and builds margin buffers. The first margin hike catches everyone off guard. The second catches fewer. The third catches almost nobody. Each subsequent deployment produces a smaller crash with a faster recovery. The banks got their $12 crash. They got $85, but $85 held. The bounce was immediate. The physical market did not blink. ETF buyers increased their positions. Delivery demands remained unchanged, and the lease rate bleed continues. Everything they spent to engineer this $12 decline is a sunk cost that produced zero structural improvement in their position. And now the ratio reversion begins. Gold to silver at 60.1, reverting toward 54 to 55 over the next 2 weeks, based on every historical precedent. That reversion alone implies silver at $95 to $98. With any continued gold strength from the Iran situation, $100 returns to the target window within 7 to 10 trading days. The margin weapon was deployed. The maximum damage was $12 and a bounce off the breakout retest zone at $85. Compare that to 2011, when 5 margin hikes produced a 35% crash that lasted years. In 2026, 1 margin hike produced a 12% crash that bounced within hours. The weapon is losing its power because the physical market has become too strong for paper mechanics to override. Every single data point I referenced tonight is publicly verifiable. CME Advisory Notice 26303 is on their website with the timestamp intact. Historical margin increases are documented in CME's advisory archive going back decades. CFTC bank participation reports are published every month. The JP Morgan $920 million settlement is federal court record. COMEX registered inventory updates daily. Lease rates are published on LBMA. Physical premiums are listed on every major dealer website in real time. The $12 crash was planned, filed at 11:47 p.m., executed at 3:12 a.m., bounced at 85.15. And every single fundamental that supported $97 silver on Monday supports $87 silver on Tuesday, plus the additional fuel of a gold to silver ratio sitting at a 2-year extreme that historically reverts violently in silver's favor. They planned the crash, they executed the crash, and the crash failed to break the structure. When the biggest weapon in the arsenal fails to break the floor is confirmed, and confirmed floors become launching pads. Verify everything. Trust the data, not the narrative. And I will see you in the next update when the ratio reversion begins and the paper price starts chasing the physical price back toward reality.